All right, so we took a look at the national or local markets. Now let's join Ed Ludlow, who's coming to us from San Francisco. He's got the latest on the U.S. markets. Ed, thanks very much indeed for talking to us. So a swing in retail sentiment in the U.S. First, we saw those poor retail figures a couple of hours ago, and now it's changed somewhat. What's that done to the market?
Yeah, it's actually been a really interesting day, like you said. So today we got the University of Michigan consumer sentiment reading, and there was a really sharp rebound from the previous month where they hit a two-year low. And now there's this optimism about the strength of the US consumer, the sentiment the US consumer has. But like you said, yesterday we got US retail sales. They came in month on month, lowest since 2009, biggest drop, since 2009. And that led to a lot of economists and market commentators questioning essentially the validity of those numbers. It didn't make any sense. This was for the holiday period where spending should be up. But actually, brick and mortar retail sales, as well as online, which was the biggest surprise, came in incredibly weak. Remember that these numbers came in during a time, they were delayed, first of all, because of a government shutdown here in the US, and they eventually were impacted. They came out by that. So a lot of the market looked at them and they said, well, hold on a minute, this can't be right. These aren't the numbers one would expect for that holiday period. You had NEC Director Larry Kudlow weighing in saying that the US consumer came to the shops late in the month of December and that actually he expects figures to be revised up in January. So today's sentiment numbers, people have been reevaluating. You're seeing strength in the markets. If I go into my Bloomberg here, I look at the US equity markets, the S&P 500 up around 0.8%. We're on course for a weekly gain on the S&P 500 of more than 2%. The index is trading at a 10-week high. So that's really the positivity in the market. At the same time, Devan, there's this ongoing trade discussion between the US and China. President Trump has been speaking today saying that they're a lot closer, the two sides, to some kind of agreement. We're approaching this March 1st deadline where the US will impose a higher level of tariffs. But President Trump was saying earlier today that on the trade front, that deadline could be extended and that tariffs could be kept at their current levels. So the market's taking all of that into account. Looking at other areas, the Dow Jones in the US equity market's up 1.5%. The NASDAQ is up 0.4%, a more muted gain, and that might be because of some pressure on chip makers and semiconductors. We had Applied Materials give earnings yesterday and a very conservative, in fact weak forecast for the current and coming period, and that's weighing on the index somewhat. Also, it's been a kind of mixed day in terms of the dollar and US 10-year yield. You saw the dollar make gains in the early part of the days. In fact, it's kind of changed course now. It's a little weaker. The Bloomberg dollar spot index weaker by 0.2%. And the similar picture of US 10-year yield. The yield was rising with the dollar up to around 2.68%. It's down now to 2.67%. And actually all week the US 10-year yield has been within this narrow range. So, a more positive picture in the markets today on this Friday. Investors taking on board the strength of the US consumer. Don't forget, of course, we're in the midst of earnings season, and as all of these companies report, that's what investors will be looking for. What does that say about the strength of corporate America, and what does it say about the strength of the US consumer?
Yes, indeed. And we've seen that weakening dollar effect on our rand strengthening a little bit in the past hour. I want to ask you about oil, though. We've been warned here in South Africa about a fuel price hike, partly because of a rise in Brent, $66 at the moment. What's your take on where this is going?
Yeah, it's really interesting. A lot of momentum behind Brent. And actually, it's funny because oil is such a dynamic story. And if you take your eye off it for a moment, then you can kind of lose track of where it's going bigger picture. So Brent up around, I'm just looking here, 2.8% at the moment, but its year-to-date gain is around 23%. That's pretty incredible. It's on course this week for a weekly gain of almost 7%. And again, it all goes back to this global initiative, OPEC and its non-OPEC partners, OPEC Plus if you like, trying to take some of that supply out of the market, continuing to curb the output. In terms of new flow, there's two big drivers behind oil at the moment. The first is that the Saudis and their state producer, Saudi Aramco, they're going to basically have to take some of their output down because of essential maintenance. That's at the Safaniya oil field. Safaniya oil field is the biggest offshore oil field in the world. So when you get news that they're going to have to make maintenance, that's going to reduce output from there. That takes it out of the market. That puts the price up higher. And then, as I said, this initiative, OPEC Plus, has other big players, and one of those big players is Russia. We had their energy minister, Alexander Novak, yesterday speaking about Russia's commitment to that deal. They're targeting a reduction of their output. They want to get to a level of around 11.19 million barrels a day. They're some way off that at the moment, but in order to meet that target, Novak was saying just yesterday that they're going to accelerate the rate of reductions. They want to cut by around 150,000 barrels towards the end of February, and they're just pushing and pushing and pushing. So really dynamic story. Brent, global benchmark, as you say, making gains. By the way, just incidentally, WTI crude here in the US also up 2.4% today. So that's a really interesting market to watch in the coming weeks.
All right, thanks very much indeed. Ed Ludlow in San Francisco with the latest on the US market.